Hong Kong Exchange racing to attract big listings. What are some of the challenges, even as we've seen the capital markets hold up better than the broader economy?
Well, Heidi, the concern is that Hong Kong's turnover rate is relatively low compared with its U.S. peers, and it's unclear whether the U.S. will impose further sanctions and how these political turmoils will turn, whether that will deter dollars from flowing into Hong Kong even further.
And what has the Hong Kong Exchange done to increase some of the liquidity?
The Hong Kong Exchange has noticed that, well, the turnover rate and liquidity has always been an issue, and they've done a lot to improve that, including if you look at these secondary listings, they were improved in a matter of weeks. The exchange is also trying to push a cutback in the number of days for the settlement for IPOs, which could free up some of the short-term liquidity. It's also discussing whether to allow corporates to hold weighted voting rights, and that could potentially attract some of the portfolio companies that Alibaba and Tencent have invested in.
And Lulu, the other interesting aspect is that with these, restrictions, the potential clampdown of Chinese companies listed in the US, you could see a surge of returning home companies, right? What are the likes of these new listings from JD and NetEase likely to do in terms of, boosting confidence at least?
Yeah, that's a really great point, Heidi. Hong Kong's status probably is more important than ever for Hong Kong right now, especially since the proposed Senate bill, which could delist some of the Chinese tech stocks from the U.S., and that would essentially make Hong Kong the only avenue for China to tap global investor capital. But if this channel were to go, that could wreak havoc for all Chinese companies and not just Hong Kong.